CBN reports $1.5 billion inflows as boost into Nigeria's forex market. And Nigeria's refineries struggle as feedstock shortage sparks concerns. This is Business Edge. I am Lekan, Onabanjo. Happy Easter Monday to you. And of course, we start by looking at our business headlines from across the continent. The Nigerian government continues to grant tax exemptions, including pioneer status to companies like Dangote and Meccano International, despite intentions to reduce such programs and boost revenue. As of the fourth quarter of 2023, 107 firms enjoy pioneer status, up from 83 earlier. This status exempts companies from income tax for a specified period, aimed at stimulating investments in sectors lacking local presence. However, concerns persist over the revenue lost annually due to such waivers, prompting plans for review and reduction. Officials assert the incentives attract foreign investment, but critics question transparency and effectiveness. The Nigerian Investment Promotion Commission plans to assess the impact of these incentives on job creation and economic activity, aiming for transparency and alignment with tax policies. Now, banks operating in Nigeria are exploring avenues such as share issuance, mergers and acquisitions, including license adjustments to meet the new capital requirements. Some are considering Eurobond offerings and private placements. Despite some dissent, the Senate Committee on Capital Markets and Institutions lauded the CBN move, anticipating positive implications for the nation's capital market. This follows the Central Bank of Nigeria mandating banks to bolster their capital reserves, sparking a rush to devise recapitalization strategies. 12 banks are sitting on approximately 4.8 trillion naira in retained earnings, rendered inaccessible due to the CBN's directive. But that directive focuses solely on share capital and share premium, omitting other equity components. To the southern part of Africa, South African motorists will not get any relief on Wednesday when April's fuel prices will rise for the third consecutive month. On April 3, fuel prices will increase as follows. Petrol 93 grade will cost 65 cents per litre, while petrol 95 Verity will be sold at 67 cents per litre. For diesel, 0.05% version will now cost 3 cents per litre, and the price of diesel, 0.005%, will decrease by 2% per litre, as will the price of illuminating paraffin, which will see a 29 cents per litre decrease, and liquefied petroleum gas will see a 19 cents per kilogram decrease. According to the Department of Mineral Resources and Energy, the petrol price adjustments can be attributed to the high Brent crude oil price, which was up from $82.50 to $84.22 per barrel during the period under review. Finally, the African Development Bank has debarred Chinese road builder China Henan International Corporation Group for engaging in fraudulent activity in a project the lender is funding in Uganda. The ban on the Henan-based constructor will last for 12 months, effective from March 28, a period in which Chico will not be able to participate in any new AFDB-funded projects on the continent, including Kenya, where it has an ongoing project. An AFDB investigation revealed that the Chinese road builder failed to disclose the use of a commission agent, which, while submitting a bid in the context of a tender for the procurement of civil works for upgrading of Rukungiri Kihihi Shasha Kanungu to bituminous standard, a component of the road sector support project in Uganda. And that ends African Business Stories. We're now going on a break to bring you market updates. Do stay with us. Nigeria's stock market surged 39.47% in Q1 2024, topping the global charts. It outperformed major markets like Kenya, Japan, and Zambia, despite recent central bank rate hikes, aimed at inflation and currency stability. Now, this impressive performance comes despite the Central Bank of Nigeria raising interest rates twice, in Q1 to combat inflation and a weakening naira. So at this point, we quickly take a look at the figures, starting with the All-Share Index. And they received 104,562.06 with a negative of 0.08%. Let's quickly look at market capitalization. And we see it rising to about the 59 trillion naira threshold. That's 59.121 trillion naira, with, of course, minus 0.08%. We now quickly look at the top price gainers for the week. We see CWG topping the charts, closing at 7 naira 50 kobo. Morrison Industry closing at 1 naira 76 kobo. Julie PLC, that has been on and off the charts but has remained resilient regardless of what the stocks might be saying, and performance takes the third place at 9 naira 49 kobo, followed by Suno Assurances and Conhall PLC with 1 naira 36 kobo and 1 naira 63 kobo. And we see double digits in the change percentage differential, 26.05, 24, 2017, and 16.43. We'll now look at the top losers. Of course, International Breweries tops the charts for the decliners, 4 naira 45 kobo in closing, followed by Dangote Sugar with about 52 naira, Guineans 35 kobo, NNFM with 48 naira 30 kobo, and FTN Cocoa closing at 1 naira 60 kobo. Look at the percentage differentials in the negative of 14, 11, 10, 9, and minus 9. 0.9%, of course, for FTN Cocoa. Before we go, we look at the sectoral performance. And topping the chart, as always, is the banking industry with plus 1.93% in percentage difference, followed by insurance. Oil and gas still remains bland, and that's been on for a couple of months now, if not weeks. Consumer goods taking the fourth spot with a negative of 0.97%, and industrial goods at plus 0.21%. Very minimal, but then it takes the fifth spot. And that's it. Looking at the weekly report for the week ended, that is last week anyway. We'll now go on a short break and look at the first discussion for the day. Just stay with us. We'll be into it. The Central Bank of Nigeria has announced that the Nigerian economy experienced a foreign exchange inflow of about $1.5 billion just 2 days after the Monetary Policy Committee meeting. Now, this influx of funds is seen as a positive sign for the health of the foreign exchange market in Nigeria. The CBN attributes this development to its ongoing monetary policy efforts aimed at stabilizing the foreign exchange market. So to help us understand this better, I have Victor Aluyi, who is the Senior Vice President and Head Investments and Corey Global Investment. Thank you so much for joining us on Business Edge.
Morning. Thanks for having me.
Now, let's start this way. The Naira appreciated in the autonomous foreign exchange market by 1,309 Naira to a dollar, and the CBN claimed its recent policies caused forex inflow of about $1.5 billion. So can you specify which monetary policy changes it is attributing these to? Are we talking about interest rate adjustments, reserve requirements, or what?
I mean, it's generally been the entire, if you will, monetary policy stance that the CBN has adopted for the better part of this year, really, which we'll basically describe as a hawkish or a tight monetary policy stance, where this year they've basically raised the benchmark rate by about 600 basis points. They've also tightened, the cash reserve ratio from 32.5 to 45%. We've also seen a significant increase in fixed income yields, right? You've seen on the Treasury bill curve, you've seen the short end rates move by over 1,000 basis points. Same thing across the mid and the long point. If you look at the bond curve, you will see that at the short end of the curve, yields have moved by an average of over 600 basis points. At the midpoint of the curve, that's above 400 basis points. And at the long end of the curve, you've seen yields move by about 250 basis points since the beginning of this year. So clearly, all of the very hawkish or tight monetary policy stance that the CBN has pretty much implemented for the better part of this year is what you can basically attribute to, this sort of inflow that the CBN has been talking about.
So let's now look at the areas that these monetary policies are prepared. I'd like you to quickly elaborate on what types of foreign exchange transactions contributed to this inflow. Could it be foreign direct investment, portfolio investment, export earnings? What areas are we looking at?
And these are largely foreign portfolio investments, really, right? So again, the tight monetary policy stance would essentially serves to attract foreign inflows, right? And that's the reason why, the central bank has embarked on this, stance, if you will. The idea is to create price stability, right? You see inflation at over 30%. We saw the naira basically weaken very significantly, and to stem that tide, the central bank had to adopt a tight, monetary policy stance, and it is that tight stance that has then led to these inflows. And these inflows are largely, foreign portfolio investments that have just basically come to take advantage, if you will, of the high interest rates that we're seeing, right? So the one-year treasury bill, for instance, has an effective yield of about 27%. Long-term bonds are now trading around 18%, which, as I highlighted earlier, is a significant push from where we're coming from just at the beginning of this year. So all of these moves is what has basically led to this sort of inflows that have been essentially attracted to the high interest rates that we're seeing right now.
So you just described it as a significant push, but then some financial analysts say that a $1.5 billion inflow is relatively small compared to Nigeria's overall forex needs. For you, how would you balance it in terms of comparison, what is demanded for, and the volume of inflow that we have?
No, at the end of the day, it's not about the demand and all of that. A 1.5 billion inflow, which is probably over the last couple of weeks or so, recall that you're still probably getting these inflows at the various auctions that happen twice a month. So for me, it's not about whether it's going to meet the demand. It's about the fact that you're seeing significant progress on that front. You might want to recall that throughout last year, we saw a very significant decline or dwindling of foreign portfolio investments. During the early part of the year, you saw some foreign portfolio investments, but as elections came through, that declined very significantly up until towards the end of last year. So this sort of pickup, is significant. It's something to sort of cheer about. So for me, it's not about whether it meets demand or not. These are trickles that will continue to contribute to ensure that we do attain price stability over the medium term.
So, Victor, beyond the CBN policies, were there any other recent events or probably economic indicators that might have boosted foreign investor confidence in Nigeria, leading to this inflow? Because some people are asking questions as to what the point of attraction is for the investors and why they are now willing to bring their money in.
Like I said, these are foreign portfolio investments, right? These are not monies that have come to come and build factories or start up any business. They've basically come to take advantage of the high interest rate environment that we have right now. So essentially, all of those inflows that you have seen have basically been down to the monetary policy stance of the central bank that we have seen over the last couple of months. Really, is nothing else at this point. Now, as time goes on, as the fiscal situation sort of improves, yes, we'll begin to see those sort of investments, which will then turn as foreign direct investments, which might come into, build factories, take advantage of certain other areas. But as we speak now, what we're seeing are inflows that are essentially looking to take advantage of the high interest rate environment that we've got right now.
So you just mentioned the possibility of the manufacturing sector seeing some sort of investments out of this $1.5 billion. And we also know that the oil and gas industry is another sector that's yearning for investments in that regard. So are there other sectors of the Nigerian economy that are likely to benefit mostly from this influx?
Like I said, these are essentially financial markets flows, right? Just to take advantage of the high interest rate environment that we're seeing. This is, again, at its term, this is foreign portfolio investments. They're not foreign direct investments. So again, as things improve, we would then probably start to see FDIs start to flow in. But for now, what we're seeing are foreign portfolio investments.
So I would still want to ask this. Is there a reason to believe that this is a one-time inflow, or are there factors suggesting similar or even greater inflows could occur in the coming months? You are saying that, fine, they're coming in trickles and there's a possibility for growth, but a lot of people will still need assurance on what is to come when we look at it futuristically. So when you look at the crystal ball, what do you see?
Well, I mean, the truth of the matter is that as long as the apex bank stays the course in terms of monetary tightening, I think that we'll continue to see these inflows. The idea, remember that what's really happening is that the central bank is trying to create price stability, with what had happened to FX, with what is happening to inflation. I believe that until we start to see appreciable progress on that front, the CBN will not take its foot off of the pedal of monetary tightening. So once we start to see inflation, some disinflation with the inflation numbers, once we start to see the naira show continued appreciation and a semblance of some sort of stability, that's when I think that the apex bank might start to dial back on its tight monetary policy stance. In the absence of that, I think it will continue to do that, and we'll continue to see those flows come through, barring any unforeseen circumstances, really.
Okay, so still talking about monetary tightening, we've seen some other African countries that have tried as much as possible to rein in inflation by hiking the interest rates. And we've got some other countries, African countries, have actually stayed pegged the interest rates. And a lot of people are wondering if the NPC of the Central Bank of Nigeria would increase the interest rates as they have done of late to about 24.75%, I want to believe. So do you think that should continue even as it continues to deal with inflationary pressures?
I mean, with monetary policy, there's usually a lag effect, right? So you've done 600 basis points in about a month or so. I think that it will be important for the committee to hold off a bit and pretty much assess the impact of these hikes or this tightening, on the overall economy, especially when it comes to price stability. See what impact it is having on inflation, see what impact it is having on the currency, and then from there on out, be able to determine what it would do going forward. I think, that the meeting in May, I don't think that there will be a further hike in the benchmark rate. I think it will provide an opportunity for the committee to assess, what it has done so far. I also think that we are likely to start to see some disinflation right before that meeting. That will certainly provide some impetus to the committee to want to hold off and see what the impact of its, monetary policy stance has been before it then goes ahead to make an assessment as to whether it, would want to hike further or hold off on further hikes, really.
So what about Nigeria's balance of payments and trade balance with other countries? Will it also improve the values?
I mean, that's a separate thing from monetary policy at the end of the day. That's largely a trade and mostly fiscal policy stuff, right? We expect to see improvements there, basically, on the back of factors, right? We're seeing crude oil production improve. We're also seeing crude oil prices essentially remain on the ascendancy. We're seeing cocoa prices really go through the roof. Nigeria is one of the 5% globally, so that should also help with our balance of payment situation, which obviously ultimately then helps with price stability for the country. So with the monetary policy situation, I don't think that there will be any significant or major impact when it comes to balance of payment. These are other factors that I think would lead to improvements in balance of payment. Like I highlighted, crude oil production and prices, and also the cocoa situation should be very helpful as well.
All right, so we've seen how global shocks have actually affected several countries. And a couple of people are actually wondering if these policies of the Central Bank of Nigeria will be able to insulate Nigeria's economy from these shocks, because we don't know what might happen, but then we still see all these activities at the global stage having some sort of negative effects on the pricing and, of course, Nigeria's economy. Do you think that we should be worried about that?
The truth of the matter is that with global shocks, you never know what it is. You never know when it's going to happen, right? So it really remains to be seen what global shock that would be and what impact it would be. It'd be difficult to sit here and say, oh, there is this sort of global shock that may come. The truth of the matter is that Nigeria's economy is essentially on the mend. So it would not be it would not be a good thing to have a global shock at this time, because we are actually, carrying out policies that are necessary but painful to essentially turn the ship around, So I don't know what global shock might come, but I think that with the policies that we're seeing and the policies that are being implemented, with the cadence at which they are being implemented, I think that we're essentially on the right path.
So it seems all good. We're seeing investment inflows coming in, and a lot of people are actually optimistic about what it might bring. But then might not just be all good if we have to look at it critically. Are there any potential risks associated with a sudden increase in foreign exchange inflows? And if those situations come into play, how do you think that can be mitigated?
I mean, the major risk with this sort of foreign portfolio investment flows are they're essentially monies that you would term as hot monies, right? They're basically here to get the high interest rates. And once these high interest rates start to recede, these monies might want to find their way back out of the country. And at that point in time, you must have been able to build your reserves to a level where you have significant buffers to take that heat such that it doesn't then create any problems further down the line. For me, that's basically the only risk that I see, further down the line, where there's a reversal of flows once this hawkish monetary policy stance basically comes to an end. That's the only risk that I see. And if we're able to consolidate and build our reserves with increased production, taking advantage of the high crude oil prices we're seeing, also the cocoa situation that I mentioned earlier, I think that it would help a great deal for us to have been able to build reserves to a point where once we start to see the reversal of flows, it will not have a major impact on the economy. But I think that remains a risk that has to be considered.
So looking at Nigeria's economy, at what point would you say the reserves should be built to give it that bit of formidity when you compare it with other economies on the continent?
Well, I mean, at the end of the day, you need to build reserves that can cover between 18 to 24 months of imports. Right now, we're sitting at reserves of about 34 billion, which probably covers around maybe 6 to 7 months thereabouts. So clearly, there's still a lot of work that needs to be done to continue to build the reserves to ensure that we have, significant buffers that can help us tide over any unwarranted or unwanted situations, really.
All right. Victor Ali, Senior Vice President and Head Investments, Sankore Global Investment. Thank you so much for being on Business Edge.
Thanks for having me.
Of course, you're watching Business Edge on New Central Television. We'll now go on a short break. When we return, we'll bring you international business stories. Don't go away. Broadly steady on Monday as data showing easing U.S. prices bolstered bets that the Federal Reserve could cut interest rates in June, while the yen loitered near 152 per dollar, keeping traders on the edge of a threat in intervention. The personal consumption expenditures price index rose 0.3% in February, the Commerce Department's Bureau of Economic Analysis said on Friday, compared with the 0.4% rise that economists polled by Reuters had forecast. The report also showed consumer spending rising by the most in just over a year last month, underscoring the economy's resilience. Most markets across the globe were closed on Friday, with European markets closed on Monday as well. Insurance payouts for Tuesday's collapse of the Francis Scott Key Bridge in Baltimore could be among the largest ever in marine insurance, according to Lloyd's of London Chief Executive Officer John Neal. The bridge collapsed on Tuesday after being struck by a container ship, the Singapore-flagged Dali, sending vehicles into the water and threatening chaos at one of the most important ports on the U.S. East Coast. Barclays PLC analysts estimated that the insurers face claims of as much as $3 billion in a note on Wednesday. Insurance claims for damage to the bridge alone could reach $1.2 billion, Barclays said in its notes, predicting further potential liabilities of $350 million to $700 million for wrongful deaths and yet to be determined amounts for business interruptions, while access to the seaports is blocked. Asian economies are not doing as well as they could, and growth in the region is forecast to slow to 4.5% this year from 5.1% in 2023, the World Bank said in a report released on Monday. The report says debt, trade barriers, and policy uncertainties are dulling the region's economic dynamism, and governments need to do more to address long-term problems such as weak social safety nets and underinvestment in education. Asia's economies are growing more slowly than before the pandemic, but faster than other parts of the world. And a rebound in global trade, that is, trade in goods and services, grew by only 0.2% in 2023, but is projected to grow by 2.3% this year, including an easing in financial conditions being experienced as central banks cut interest rates, which is expected to help offset weaker growth in China. Finally, oil edged higher following a solid first quarter gain as signs of a nascent recovery in China bolstered the demand outlook. Brent for June rose above $87 a barrel after front months prices surged by 14% in the first 3 months of the year, while West Texas Intermediate was near $83. China's industrial activity rebounded in March to snap a 5-month decline, stoking hopes that consumption in the biggest crude importer might be on the mend. Now, Crude rallied this year as OPEC Plus cut back supplies to push prices higher and offset the impact of increased flows from outside the cartel. The group is expected to affirm its current output policy at an online review meeting scheduled for Wednesday. And those are the international business stories for you. Now we'll be looking at Nigeria's refineries that are set to be struggling as feedstock shortage is set to spark concerns. Do stay with us. The Nigerian Upstream Petroleum Regulatory Commission, NUPRC, is addressing feedstock shortages for local refineries, including the Dangote Refinery. NUPRC's Chief Executive, Benga Komolafe, instructed the Enforcement Committee to develop a template for the domestic crude oil supply obligation by Friday. Now, this initiative aims to prioritize feedstock supply to local refineries per the Petroleum Industry Act 2021. Joining me to talk more about this is Itoro Adediran, Senior Manager, Tax, Regulatory and People Services, KPMG Nigeria. It's nice to have you around on the show.
Nice to be here. Thank you very much for having me.
So to start with, for the benefit of those who may not understand, what is feedstock in terms of oil refining and what are the major reasons for its inadequate supply?
Okay, so first of all, and thank you very much for asking that question because it sets like the precedence for the conversation that we're going to have this morning. And so what's a feedstock? Feedstock is basically raw materials. What's a raw material that we need for oil refining is crude oil. Crude oil is the major item that we need for refining finished products, such as the aviation fuel that you're familiar with, the diesel that you see, the PMS that you hear about. Crude oil is that feedstock that you need. So that's what we're speaking about when we speak to oil refining. We're speaking to the need for crude oil. And in terms of its shortages, there's so many issues. First of all, we are not producing as much as we should be due to significant issues that we had in the Niger Delta, which is being addressed at the moment. So there are a couple of reasons why we don't have enough. We're also not meeting our production quota as it stands. And so there is a clamor for us to be able to meet that need, to be able to meet the needs of the domestic markets as well.
So having said that, can you now provide insights into the economic implications of this shortage in crude on the refining industry and Nigeria's economy?
Okay, so the economic impact is we would basically be spending more to import crude than we are actually selling, and we are earning in terms of revenue. And what this does is that it puts pressure on our foreign exchange. If we're spending so much more to import in USD than we're spending to actually earn, or we're earning basically, there is a mismatch. And so, of course, it puts pressure on our foreign exchange and also takes money that we could use to do other things to fund these payments. So that's what we see as the economic impact when we say, oh, there is a feedstock shortage. The refineries do not have enough to produce. If they don't have enough to produce, then we don't have enough to sell, which means that we still have to spend more money to import crude, to import refined products rather. And when we do that, we put pressure on our foreign exchange. If we're able to refine locally, we'll be able to save ourselves that pressure.
So then this actually draws me to this question. Earlier on, you talked about unrest in oil producing states, vandalism, oil theft and all that. But then we have a Petroleum Industry Act 2021 that provides for the creation of the domestic crude oil supply obligation, which aims to address the feedstock shortages for local refineries. So can that efficiently help address supply concerns when we still have some other endemic issues that has to do with volatility or violence, rather, let me put it that way, in the producing regions?
Okay. I'll take it first. Yes, it should. And again, let me just briefly explain what that domestic crude oil supply obligation is. What it essentially means is that we prioritize the local refineries. So instead of saying we're exporting all that we produce, we give preference to the local refineries. And what we do is that we give them feedstock before we export the rest, which means that they are able to refine based on what we have provided to them. Now, do we have enough? That's a second conversation. We are seeing a boost in terms of, and we're seeing more investment in that space. But also, it's still not enough for Nigeria to meet its quota production, because as I know, we are doing less than we are supposed to be doing in terms of production quota. So we still don't have sufficient enough to be able to go round per se. But can it address? Yes, it is supposed to address. If followed strictly, it should address that concern, and we should still see local refineries have feedstock that they need to produce refined products. So it should address it. But in terms of the actual stock being available, we are seeing improvements in the Niger Delta. We're also seeing slightly improved production than before, which means that we are seeing security concerns come to play, and we're seeing it being addressed, and we're seeing resulting increase. But is that enough to address all our concerns? We may need to watch to see how that plays out. But if this domestic supply, crude oil supply obligation is met in full, it should be able to help Nigeria meet all its needs.
Well, just as you have said, all right, just as you have said that the DSCO requires all producers prioritizing supply to certain amount of crude oil to Nigerian refineries before exporting it. We now look at the refining or the refineries that we have in the country and the capacities. Which ones can you mention? We know about Dangote Refinery. We are not too sure about the Warri Refinery, and we also heard that the Port Harcourt Refinery should have picked up just about 2 weeks ago. The government said that it would pick up and start functioning. We don't know what the state is. So when we begin to talk about refineries that should begin to pick up these crude commodity for refining processes, do we really have them in their numbers and the capacity for them to do these refinings?
Okay, I'll smile because we just have the Dangote that is up and running now, like you said. And that's one thing that comes to play. We need to put more investments into the refining space. We can be able to meet up these needs if we activate the refinery. We need all hands on deck. Like you mentioned, we have the Dangote refinery. The Port Harcourt refinery was supposed to have picked up in April. We would wait and see how that plays. But in terms of functional refineries at the moment, we are still struggling on that end, which is why it's very important for us to incentivize people that are in that space and see how it plays, because they are the ones that would help all hands on deck to be able to make us meet the needs that we have domestically instead of importing. We still have a struggle in terms of refineries. Like again, I mentioned, it's just Dangote now who is doing about 250,000 per day, liquefaction per day, sorry. So basically, if we stay with that, we can see that we still have a lot of work to do in that space. We need to attract the relevant investments into that sector to be able to get more refineries on board, to be able to enable us achieve the results that we seek to achieve.
Okay, so earlier on, you talked about how the issue around this refining, the dwindling refining capacity affecting Nigeria's revenue and overall its economy. Let's now tie it to commodity price, and I'd like you to be very categorical about this. If we have enough crude to refine and we have enough refineries to do their processes, do you think it would have any impact whatsoever on the price of these commodities? Because a lot of people have come out to say that, oh, the price will reduce. Then NPCL last week said, oh, there's going to be a reduction in pump price. We saw a speculation of about 10 naira, and some people felt that that 10 naira margin is inconsequential. So I'd like you to be very categorical when it comes to optimizing the amount of crude oil that we have and the infrastructure to deal with the process of refining. Are we going to have a reduction in prices?
Okay, so this is how I'm going to make it very clear. For example, if you have something that is being produced domestically and you have something that you have to spend money to buy, which would be appeasing to you at this point, is what it is. If I'm refining locally, I expect the price to drop because there are some costs associated with importing that I'm not going to spend if I'm able to get that money internally. And so basically, if I'm doing refining locally, I'm able to save costs such as transportation costs, and that's actually may translate to something significant when you get to the final cost of the PMS when it gets to pump price. And so it's very important to look at it holistically and say, okay, I'm not spending money I would have spent to import this product anymore. If I have my refineries working, I have enough stock for my domestic needs. I do not have to import. So in that instance, I would spend less, or I should spend less, because my costs would reduce, seeing that it's being done in Nigeria, and all the additional costs such as transportation, storage, all the associated costs that I would have spent in USD, I would be able to save on those costs and be able to use it to do something else, because it's being done domestically, and I will save some cost on that. So which is why it's very important for us to have the local refinery work. If it works and our domestic needs are met, it should eventually lead to a gradual decline in the cost of pump price, which would actually help the plight of Nigerians at this point.
So what about refinery owners as regards payments, currency issues, additional investments that are needed? We heard that they made an appeal. What do you think the reservations are and their concerns that need to be addressed?
Okay, I will speak from the part of the refinery owners. Okay, but before I even get into that bit, I will speak on the part of the producers as well. For people producing, they earn their money in USD, and you'll be aware that the oil and gas industry in Nigeria is heavily USD denominated. But the refineries are going to work in Nigeria, and they are going to sell their finished crude or their finished product in Naira. So there's going to be that mismatch in terms of, oh, would the producer sell to me in Naira or would they sell to me in USD? That's where the conversation comes to play. So those are their concerns. Because as a refinery owner, I won't want to buy crude in USD and then sell my finished products in Naira. There's going to be that foreign exchange fluctuation in my business, and it doesn't really work for my economics at the end of the day, for the model of my business, right? And so their concerns basically is, first of all, how would this crude oil be sold to me as a refinery? Will I still have to hustle for USD before these payments are made, or would the payments be made domestically? Those are the kind of challenges that they are having. And then again, we also speak to the issue of incentives. What incentives are the government giving to refineries to ensure that they're doing very well? Also, how do they have access to financing that they need as well? So there are a couple of issues that they have that need to be addressed. But I think top of the list remain the currency. How is it going to be settled? How are the payments going to be defrayed? Because on the producer's end, I don't want to be worse off because I have supplied local markets, which is supposed to help the local refinery do better. I also want to be in the same space I would have been if I had supplied international markets. So I think that's one way for us to look at it this morning.
But then for you, if you had to advise, what do you think should be appropriate in terms of payments? Should it be in the local currency or dollars?
I'm not, so again, this is a commercial discussion. Yes, so I think that both the producers and the refineries should actually together to have a conversation on what's mutually beneficial for both parties. What's a win-win for both of them? It may be that, oh, one party may say, okay, let's get at this prevailing exchange rates, or let's pay in just USD, or let's even see how we can structure the payment. But I feel like that's commercial, and that's between the both parties. They should be able to come up with a position that works for both of them.
All right, finally, before I let you go, bearing in mind the various challenges bedeviling the sector, you mentioned a couple of them. Can Nigeria become a net exporter of refined petroleum products?
Okay, can Nigeria become a net exporter? Okay, first of all, let me just explain what a net exporter means. A net exporter means someone that's able to meet your domestic needs and still export the balance. So it means that you're exporting more than you're importing. With the situation on ground in terms of how the refineries are, we don't have all of them working yet. As at this point, it may be tough to say we can become a net exporter, but it is not impossible, because again, if we throw in the right investments, throw in the right incentives, throw in all the support that the refineries need to be up and running, we can get to the point where we become net exporters. Can we get there right now? Yes, we can, but we need to throw in that investment. Without investment, we will still struggle, and we would even barely be producing enough for us to use as a country. But if we continue to spend more time investing and training all the support that the refineries need, supplying them crude stock, crude oil, supplying them in training incentives that makes them want to do better, providing them the relevant financial support and every other thing that you need to basically pick up and run properly, then we can get to that point. But again, we cannot just get there by sitting down and wishing. We have to ensure that we put in all the investments, put in the hard work, and throw in everything that we need to train to support the refineries.
Okay, so before I let you go, one more question. Now, recent data have actually revealed that marginal uptake in functional oil drilling rigs reached 16 in February, signaling some sort of continued advancement in Nigeria's oil output installations. So do you think that would have an impact on what we've talked about all the while, that is the shortage in the feedstock?
It should. it should have an impact. We are seeing, and again, it's so good to hear the numbers and so good to hear all the activities that are happening in that space, in this space. It's very, very good to hear them. But I think for me, critical is we're seeing all these activities, we're seeing an uptick in numbers. Is it essentially translating into increased production? Because as at now, we're still struggling to meet our quota. And that means that we're still underproducing. Even so, despite the figures that you're hearing, despite everything that you're seeing, Nigeria as a country is still underproducing. So it's a dicey conversation to say yes, because it should after a while we should be able to see that it come to play. But in the interim, it may be a tough spell because we're still not meeting our quota as we should. And without meeting the quota as we should, it's tough to say, oh, we would meet basically the needs that you're looking at.
All right, well noted. Eitoro Adediran, Senior Manager, Tax, Regulatory and People Services, KPMG Nigeria. Thank you so much for your time on the show.
Thank you for having me.
And that's the end of today's edition of Business Edge. You can visit our social media handles at News Central TV and also visit our website www.newscentral.africa and equally download our mobile app on App Store and Play Store. I'm Lekan Onabanjo. Enjoy the rest of your day.